Imagine retiring after decades of work, believing you have planned everything correctly. You have the state pension, a workplace pension, maybe savings earning interest. Then your tax code changes, and HMRC takes more than expected. Not because tax rates suddenly doubled, but because pension income is not automatically tax-free. For 2026-27, the full new state pension is worth roughly £12,550 a year, while the standard personal allowance is around £12,570 per year. That leaves almost no tax-free allowance for private pensions, savings interest, rental income, or part-time work. So why are more retirees being pulled into tax? And how can you avoid an unexpected bill? Let's find out.
Retirement income can come from several places: the state pension, workplace pensions, savings, investments, property, or part-time employment. HMRC looks at the combined taxable total, not each payment separately. That is where the surprise begins. And because these payments may arrive from different providers at different times, it can be difficult to see the full picture. A pension payment may look small. Savings interest may seem insignificant. Occasional work may feel like harmless extra income. But once everything is combined across the tax year, the result can be very different from what you expected.
Click Confirmation. By the end of this video, you will understand why more UK retirees are paying tax, how pension withdrawals can create avoidable bills, and what you can do to protect your retirement income. If you enjoy practical videos about pensions and personal finance, subscribe because we upload content like this every week. Transition. To understand the problem, let's look at a retiree whose income seems completely ordinary. The tax bill many retirees never expected. Meet Linda. Linda receives close to the full new state pension, worth roughly £12,550 a year, plus around £6,000 from an old workplace pension. Her total income is approximately £18,500. She assumes the state pension is tax-free and believes the workplace pension will face little tax because she paid into it while working. But the state pension is taxable income, even though tax is not usually deducted before it reaches her bank. Because it uses almost all of Linda's personal allowance, most of her workplace pension becomes taxable. Depending on where she lives in the UK and her wider circumstances, that could mean roughly £100 a month in tax. Linda is not wealthy. She has simply crossed a frozen threshold by combining two ordinary pensions. Add savings interest, rent, or part-time earnings, and the bill could rise further. This can be especially frustrating because Linda may have built her retirement budget using the gross figures shown on pension statements. She may have already committed to regular expenses before realizing that her actual monthly income will be lower. Why is this becoming a bigger issue? Because one important number is rising while another remains frozen. The UK retirement tax reality. During 2026-27, the full new state pension is roughly £12,550 a year. The standard personal allowance remains around £12,570. That means the full state pension sits almost directly beneath the point where income tax begins. The state pension has been increasing, while the personal allowance has remained frozen. This creates something called fiscal drag. Tax rates do not need to rise. Instead, income increases while tax thresholds remain unchanged, gradually pulling more people into the tax system. Even a state pension rise, intended to protect retirees from higher living costs, can leave more private pension income exposed to tax. Scotland uses different income tax bands and rates, but the main issue remains the same. Retirement income is combined and measured against available allowances.
Pattern interrupt.
A retiree can receive a pension increase and still lose part of it through tax. The pension rises. The allowance does not. And HMRC quietly collects the difference. 5 retirement tax traps. The first trap is believing your entire pension pot is tax-free. People often hear they can take part of their pension tax-free and assume most withdrawals will escape tax. But only part of the pension is normally available tax-free. The remaining amount is generally taxable when withdrawn.
A large withdrawal for a car, home renovation, or family support could push total annual income into a higher tax band. The expense may be reasonable. The timing may not be. The second trap is emergency tax. When someone takes their first flexible pension withdrawal, the provider may temporarily use an emergency tax code. HMRC may initially treat that one payment as though the same amount will arrive every month. The tax deduction can therefore be much higher than the person's final annual liability. The excess may be refundable, but the retiree might need to submit a claim or wait for HMRC to correct it. The third trap is misunderstanding how state pension tax is collected.
The state pension is normally paid without tax being deducted. HMRC may instead collect the tax through the code used for a workplace or private pension. That can make the private pension look unusually heavily taxed. Where PAYE cannot collect the amount, HMRC may send a separate assessment. The fourth trap is savings interest. Interest earned outside an ISA can become taxable once the relevant allowances are exceeded. A retiree holding significant cash savings may therefore create an extra tax liability without withdrawing any of the original money. The fifth trap is ignoring the combined total. A small pension may look harmless. So may occasional work, rental income, dividends, or interest from several accounts. But HMRC combines taxable income sources. Several modest payments can create a surprisingly large annual bill.
Does this mean retirees should avoid withdrawals or reject extra income? No. The aim is not to eliminate tax completely. It is to avoid unnecessary tax caused by poor timing, incorrect tax codes, or a lack of planning. How to reduce the surprise? First, create a complete retirement income map. List the gross amount you expect from the state pension, private pensions, employment, rent, savings, and investments. Use the figures before tax because that is what determines which allowances and tax bands apply. Second, check your tax code. Review it whenever you begin receiving a new pension, stop working, or take a large one-off withdrawal. If HMRC is using an outdated income estimate, ask for it to be corrected. Third, consider spreading flexible pension withdrawals across different tax years.
One large taxable withdrawal can create a bigger bill than several smaller withdrawals. However, tax should not be your only consideration. Your spending needs, health, investments, and emergency savings also matter. Fourth, use tax-efficient accounts where appropriate. Interest and investment returns inside an ISA are generally protected from UK income tax and capital gains tax. This can reduce the amount of taxable investment income sitting alongside your pensions. Fifth, check whether too much tax has been deducted. Never assume an emergency tax deduction is the final amount you owe. Review the payment statement, identify the tax code used, and claim a refund when necessary.
It can also help to keep a simple annual record of every pension payment, withdrawal, interest payment, and tax deduction. Do not rely only on bank balances. A basic spreadsheet or notebook can help you spot when total taxable income is moving closer to another tax threshold. Finally, seek guidance before making major pension decisions. PensionWise offers free guidance for eligible people with defined contribution pensions. More complicated situations involving several pensions, property, inheritance, or investments may require a regulated financial advisor or tax professional. Let's bring everything together. The full new state pension for 2026-27 is roughly £12,550 a year. The standard personal allowance is only slightly higher. That leaves many retirees with almost no unused allowance for private pensions, work, rent, or taxable savings interest. The state pension is taxable, but usually paid without tax being deducted. HMRC may collect the tax through another pensions tax code or through a separate assessment. Large withdrawals, emergency tax codes, savings interest, and multiple income sources can all make the final bill larger than expected. The solution is visibility. Know your combined income. Check your tax code. Plan withdrawals carefully. Use tax-efficient accounts. And challenge deductions that appear incorrect.
Retirement tax is not only a problem for millionaires. It can affect someone with an ordinary state pension, a modest workplace pension, and a lifetime of careful saving. That is what makes it easy to underestimate. The biggest mistake is looking at every income source separately. HMRC looks at the complete picture. So before making your next pension withdrawal, check how it interacts with everything else you receive. A little planning could prevent an unexpected tax bill and help your retirement income last longer. If you found this useful, like, subscribe, and turn on notifications for more practical videos about pensions, tax, and financial security. Thanks for watching, and I'll see you in the next video.